Everyone, welcome back to the channel. I got a special guest today from Harvest ETFs, Chris Heeks, Senior Portfolio Manager at Harvest ETFs. This is not your first time on the channel, but first time with Harvest. How you been, Chris?
I've been doing great. I've been doing good and watching the channel and good to be back in a seat here at Harvest and glad to be back here again.
Yeah, and today is actually a great time to talk about two new ETFs that are launching from Harvest, low volatility ETFs, which you're going to be managing. So you're definitely the right guy to talk to about this. And I'm going to be just sharing my screen to show people here. So you have the Harvest Low Volatility Canadian Equity Income ETF. So the stock symbol HVOI. Then you have a regular or non-covered call version. HVOL, which is the Harvest Low Volatility Canadian Equity ETF. So I was looking through these. Now we don't have, these are actually going to be coming out early next week. So just for the record, we're actually filming this on the 11th of April. But I think by the 15th, the ETFs should be launched and then you'll see the 40 stocks, the 40 names. But yeah, so these ETFs are going to be low volatility ETFs. They're going to have 40 stocks and there's going to be 4% maximum weight per name. If we look at the management fees real quick, it's 35 basis points for the regular version or the non-covered call version and your standard 65 basis points for the covered call version. So tell me all about these ETFs. You're going to be managing them. You're, I guess, maybe the architect behind them, if you will. So tell me, why are you guys launching them now, which seems to be a pretty good time because everyone's scared of volatility.
Yeah, like volatility is always an issue in equities and, it can be used for good as well as bad,
Yeah.
we have Harvest and, we do a lot of cover calls and we turn that volatility into something good, which is income. But low volatility is kind of another way to address, like, how do you address volatility in the market? We know there's a lot of clients who want the equity growth and that long-term capital appreciation that are associated with equities, but they don't like the risk profile of the markets. And if we're talking about risk, we know this year, 2025, we're probably seeing more risk and certainly more uncertainty than we've seen in many years with Trump and his tariffs and all these
Yeah.
debacles. So, the question becomes, how can you invest, but, diversify, mitigate some of that risk that's in broad markets? And that's really where, a low volatility approach can fit in really well, can help protect you when the markets are going down. But well-constructed low volatility portfolios, you can actually do very well on the upside as well, market-like or even market excess returns, if the market is favorable. So, it's a very powerful tool for investors and especially investors who are, concerned about risk. And so we're excited at Harvest to be bringing, two strategies to the market on April 15th, listed on the TSX.
Okay, are both ETFs going to have the same companies? I saw 40 stocks. The names are not available yet. They're going to be available next week. By the time this video comes out, the names will be known. Same 40 stocks in both ETFs?
Yeah, so it's going to be the same portfolio. What you have
Okay.
with the HVOL, HVOL, is it's an equity only strategy. So it's going to have those 40 names, 4% max weight. That the lowest name is going to be around 1%. So you'll see 40 names and weighting ranging from about 4% down to 1%. Just a simple equity strategy, low cost. And then what we're also really excited about is the HVOI, the HVOI. And that's going to have the same 40 names, same model portfolio, but that option overlay to add income. And, that we think that's going to be really valuable. And it works really well with low volatility investing too, because, a lot of our investors already want to reduce risk. Well, the cover call strategy, as you know very well, can add extra income and reduce risk as well. So it's going to be the first of its kind here in Canada to have a low volatility with a high monthly income payout. So we're very excited about that one as well.
Awesome. Let's focus on the covered call one. That's what my channel is personally, all about. Is it the same typical Harvest covered call strategy where it's up to 33% of the portfolio, or is it different for this specific low volatility covered call ETF?
Yeah, very similar. It's going to, probably out of the gate be about that 33% focusing on covered calls. We can actually go up to 50 in this strategy. And
Okay.
And something that's a little new for Harvest as well is we're going to have the flexibility to use puts as well. And puts,
Oh,
selling puts is it's a complementary strategy to selling calls, but it just gives us as a manager more tools to generate income. Also helps us mitigate risk in some cases. So yeah, out of the gate, you're going to see very similar cover call strategy, but we're going to see you'll probably see some of those puts being layered in as we move through kind of the year, and think that'll be that'll be additive to the income returns as well.
okay. Tell me about these 40 stocks, these 40 companies. We know that, there's the TSX 60 in Canada, the index. I'm assuming a lot of these 40 are going to be in that index. Tell me, how are you choosing these companies? Obviously, I know we want low volatility.
Yep.
And why put that 4% cap? So maybe you could just talk about stock selection, that kind of thing within the portfolio.
Yeah, for sure. So, it starts with the risk score. So we're going to start with the Canadian stock market, large and mid cap stocks. We score all of them on multiple dimensions, and that's one thing in the space. A lot of times you just see one dimension of risk being scored on. At Harvest, we're going to do multiple dimensions. So we're going to look at a security's beta. We're going to look at its realized volatility. We're going to do something no one's doing, which is look at implied volatility, which I think you'll appreciate. So looking at the volatility derived from option prices. So it's the first time we're looking at forward-looking volatility. And then in addition to that, we're going to layer in a couple fundamental screens as well, because sometimes and here's a great visual here. Sometimes you could have a company, it's got a low beta or low risk, but it doesn't mean it's got a great return profile going forward. So we also are going to look at some fundamentals like net income growth, technical strength, and make sure A, we're investing in low risk companies, but also B, these are good, solid companies to hold for the long term as well.
Awesome.
So,
Yeah.
so that's the heart of the risk scoring. And then as you go down that pyramid, as you see the top 40 names that we're going to be including into the portfolio, are going to be a combination of that risk score times the market cap size. So you're going to have two things at play. You're going to have the risk score that's going to put us in the lower risk stocks. And then we also have the market cap, which is going to make sure we stay in large cap names. It's going to make sure we're aware of where the market cap is. And that's going to help the fund grow over time. As the market cap does well, the fund will do well as well accordingly. So that's how we're going to put it together. 4% is just a nice maximum weight for us to have and keep things spread out. If we didn't have it, we'd probably have a couple like Royal Bank would go north of 4 because
Yeah.
it's almost, bordering on 10% in the index. But, we want a nice diversified portfolio. When we're able to share that portfolio, sorry, we can't do it today, but, on Tuesday, April 15th, you can, go to our website and check it out, first thing in the morning, and it's going to be there, and you'll see just really, blue chip Canadian large cap basket, some banks, some pipelines, some defensive names like Waste Connections, Dollarama, Fairfax Financial. These are like really nice Constellation Software, really nice low vol names that have been really accretive over time. You'll see some industrials too, like some of the rails to balance out the portfolio. So, very blue chip defensive portfolio that I think is going to be really well positioned for investors looking to get into low volatility.
Yeah, I don't think many people are going to be surprised by a lot of the names when they come out, but you talked about it. I'm assuming they're going to be the really the solid, big cap, blue chip, many dividend stocks in there as well. So, this is going to have a cover call overlay, 33 maximum up to 50% coverage. Are you thinking in terms of the cover call strategy, is it flexible? Are you doing a rinse and repeat, or is it like an active cover call strategy where every month you're going in and say, okay, I'm going to write maybe on these names, out of the money on these names, maybe on these names I won't write because we feel like they have a lot of potential for growth. Tell me a little bit about like the month-to-month cover call strategy, which I know is going to be active one.
Yeah, and for sure. And that's something I'm excited about, being at Harvest, is we have that ability to utilize an active oversight approach. So we can go up to 50% on any given name, and we can really source out the opportunities, like where is vol the richest, what stocks look the best to sell calls, what stocks are maybe set up for that kind of recovery, and we don't want to sell as many calls, that month. because we want the growth as well as the income. So, at Harvest, we've got that active ability to really turn it on, turn it off for each individual name. We got kind of our benchmark rate of what we want to earn for the fund, which is the distribution payment. We're going to earn that every month. But how we get there, we can go about it in a much more active way. So, I'm really excited about that, and having that flexibility. I think we can, incrementally add return for investors with that type of approach, just like Harvest is doing in its, classic funds like HHL and HUTL and et cetera.
Yeah.
Employing that active approach.
Yeah, this is not a rinse and repeat approach like some fund managers have. This is an active approach. That was one of my questions for later on. So you answered it now. That's great. I'm just curious, why just focus on Canada? Are you guys launching maybe any, I know you can't talk about future products, but did you start with just the Canadian one to see the reaction? And why not, for example, a US one, or maybe that's for the future, hopefully, your comments on that.
Yeah, for sure. And I'd be really excited to do a US one as well. I'll put my chips on the table where they are, because I think it's a very interesting approach in the US. And even in the US, you're already seeing this rotation this year away from kind of the Mag 7 types to a more diversified kind of mix that's doing the best. And low vol is one of the top performing factors. It's actually the top performing factor in the US. So I'd be really excited to do one there as well. I think for investors, we just want to help them diversify. To be honest, Harvest, we got a lot of US-based solutions. There's room for a Canadian solution to start here, but hopefully, as we keep building out, we'll just be able to keep offering, these types of solutions, because I think they can be, very effective in other markets like the US as well.
Okay, awesome. And I'm not sure if you'll be able to answer this. I know it's a bit touchy to modifications for products, but maybe I'll ask this way. Is this when the covered call ETF launches, could it be a candidate to be added in Harvest's all-in-one solutions like the HDIF or that's the leverage one? There's a non-leverage one,
That's
or
right.
the one with a 60/40. Could this be added in there, do you think, or be a candidate?
Yeah, it would fit the candidacy for those. And in those HDIF strategies, HRIF, we're trying to create diversified portfolios. And I think low vol is something that can help diversify, versus some of the holdings there. So definitely a candidate there, and something we can, potentially look at. If it works for end investors, it's going to work for HDIF too. So, we're always trying to be very diversified in those strategies. And so we'll be seeing if that makes sense. We can,
Okay.
potentially add some there.
And this is a new product, so I know we can't really talk about the yield. I mean, we'll have to wait till the first distribution is declared. I'm assuming this is gonna, the cover call when I'm talking about monthly distributions, right?
Yeah. So the cover calls a monthly. The equity only will be a quarterly. We're going to declare those distributions right on April 15th when we launch them. So you'll see
Okay.
what it's earning. I think it's a very good level for a really well-grounded Canadian equity portfolio. So hopefully you'll like what you see, Adriano. And but yeah, that'll be there as well Tuesday morning.
Sounds good. Sounds good. And yeah, I mean, I'm assuming there's going to be a lot of dividend stocks in there as well. So you're going to have dividend income as well as covered call income. So my guess would be that a lot of the income, most of the income is going to be classified as capital gains and or ROC for the covered call portion. But then you'll also have some eligible dividends in there. So sounds like a very tax efficient ETF in a cat for a Canadian's cash account, for example, because you'll be getting the top I'm not going to say the best, but the best types of sources of income. You're not going to get any interest income or foreign income, right? It's all Canada, so you're basically getting those eligible dividends and covered call income. So
Yep,
yeah, I mean
that's right.
it's pretty straightforward. I think we covered everything. I'm looking forward to not only seeing the names, which I'm sure there's not going to be much surprise to anyone, but also the first distribution, so we could calculate and see what the kind of yield we could expect. But yeah, it's awesome. It's great having you back now with Harvest, and hopefully we have you back on the channel more for other products that are launching from Harvest. We're always looking forward to the new ones. So unless you have anything else, did I forget anything or anything you want to add on these two products? Maybe we could just end off on they're designed for what type of investor do you have these products in mind? You talked about rotation just earlier. A lot of people are kind of there's a fear of, let's get out of stocks and go into bonds and things like that. But this is a really cool way to stay in stocks, just with a little bit lower volatility. So for who did you design this ETF for?
Yeah, no, 100%. This is about staying invested, staying in equities, but having, a little bit of a safety net around you, or higher income stream, which is also in a way its own kind of safety net by turning, some of the volatility into income. Like listen, like low volatility strategies, I think initially they were designed for the risk averse. So, that characterize maybe the pre-retiree or retiree crowd. But listen, what low vol, strategies have proved over the years is they can be very good accumulators of total return as well.
Yeah,
So it's not just for, necessarily an older client. It can be, it's an all season vehicle. And, the way we're really designing this one is, this isn't a low vol you want to hold when things are bad and then sell it when things get good to go to something more aggressive. This is something we're designing to hold through the market cycle, be good on the downside, but also just as importantly, be good and capture the upside on the upside as well. So that's the way we're designing it. So, I think it can suit a lot of different investors and, just help be an important part of the portfolio and, take care of those Canadian equities in a productive way.
yeah, it could be a great ETF for Canadian retirees because you have the extra, I guess, protection with the covered calls, but you also have low volatile blue chips, solid companies that probably aren't going to go anywhere for a period of time. Plus, you have that monthly income, so it kind of, unlike growth investors who need to sell something to make money, I mean, you're making that consistent income, so you're okay to stay in. It's like a psychological protection, I call it. For me, being an income investor, it's kind of like a psychological protection because yes, your portfolio could fluctuate, but you still get that consistent income. So you're able to stay in, 100% in stocks for the long term. So this could be a great ETF for retirees to think about, which is a pretty big part of, the PII community. So Chris, looking forward to the names and the launch next week. I'm sure many of the members are going to be happy about this one, especially now. It's a great timing for a launch, by the way. So again, thanks again, my friend, for coming on, and hopefully we'll have you back soon.
Great to be back. So look forward to it. Thanks very much.
Thank you.